business owner, they might have significant value tied up in that company. They may not have the cash available to simply just write a check as part of a divorce settlement. And so really, understanding that whole financial picture, sometimes both spouses have a clear understanding of the finances, but sometimes one spouse has managed a business or the household finances for years, and maybe the other spouse hasn't. So in situations like that, part of our job is simply helping everyone understand what the financial picture actually looks like.
Welcome to the Herlihy Family Law Podcast, your trusted source for expert insights on navigating family law matters with clarity and care. Whether you're tackling tough decisions or seeking guidance for your family's future, we're here to help. Let's get started.
Welcome to the Herlihy Family Law Podcast. I'm your host, Alison Herlihy. Divorce isn't just an emotional and legal process. It can also have significant financial consequences that many people don't see coming. From unexpected tax bills to determining what a business is actually worth, making informed financial decisions can have a lasting impact on your future. Today, I'm joined by two experts from a local accounting firm, Wilkins Miller. Brandi Morgan is a CPA who helps clients understand the tax implications of major life events, including divorce. And Lyndsey Dixon is also a CPA and a certified valuation analyst who specializes in business valuations, forensic accounting, and litigation support. They're here to help us understand the financial side of divorce, including some common misconceptions, and share practical insights that can help individuals make more informed decisions throughout the divorce process. Brandi and Lyndsey, thank you for being here.
Thank you for having us, Allison.
Tell us a little bit about your backgrounds and what each of you does at Wilkins Miller.
Yeah, I'll go ahead. So I'm Brandi Morgan. I'm a CPA, a partner at Wilkins Miller. I also lead our outsourced accounting services practice, which focuses on helping businesses and their owners with understanding their financial picture and making informed decisions. But in addition to that, I have over 20 years of experience with tax planning and compliance. And so I've had the opportunity to work with clients along the way when they've had significant financial transactions or, major life events such as a divorce.
Yeah. So I'm Lyndsey Dixon. I'm also a partner at Wilkins Miller. As Allison said, I'm a CPA. I'm also a certified valuation analyst. I've been in public accounting about 20 years and have probably done every manner of public accounting, audit, tax, a lot of consulting here in the last several years. My practice focuses on business valuation, forensic accounting, and litigation consulting. I also work with Brandi a lot in the outsourced accounting services area, doing a lot of advisory services in terms of outsourced controller and CFO types. And, in many of the divorce cases that we work on, the largest marital assets are privately owned businesses. So my role is to determine what those businesses are worth and help attorneys and their clients understand the financial facts so they can make informed decisions.
How did y'all both become involved in working on divorce-related financial matters?
Well, for me, I think it just happened naturally, right? As we are working with clients, through their life. I mean, these are long-term relationships that we're building with business owners, with individuals. And so it just naturally happens as these major life events or transactions occur, whether they're starting a business or they need to sell a business, they may be planning for retirement. And unfortunately, divorce also is one of those major life transitions. And so we can be really helpful and come to the table to work with the attorney, to really think about the financial and tax implications of a transition such as that. As divorce, it's a really emotional and probably stressful process for a lot of people. My role has been just to try to remove some of the uncertainty with the financial side of that picture.
Yeah, similarly to that, my background has always been in helping business owners understand the financial side of their businesses. So over time, that naturally has expanded into business valuation and litigation consulting. Divorce is one of those areas that's especially valuable because a privately owned business is often one of those largest marital assets. And attorneys need someone who can independently determine what the business is worth and explain the financial issues in a way that's understandable. And that's where I come in. A lot of this is we're not advocating for one spouse or the other. We're applying professional standards to determine what a business is worth.
Well, and you have to abide by those professional standards regardless of who's hired you, right?
Absolutely.
I mean, like
Absolutely.
if spouse A hires you to value the business, you can't like fudge those numbers to make them
Oh,
happy, right?
absolutely. The CPA credential and also the CPA credential, both of those come with professional standards that we are required to abide by and support. And absolutely.
What are some of the most common financial issues that y'all see in a divorce?
Sorry, I'm going to go ahead, Lyndsey. You know, when you're going through a divorce, you're obviously focused very much on the here and now, and you're just trying to get through that process, right? But there are some long-term implications that you do need to think about as you're going through a divorce, whether that be future tax obligations related to assets that you may receive in the divorce. Particularly thinking about cash flow. What does that look like after the divorce? Because you may be awarded real estate, let's say, but have you really sat down to think about, do you have the cash flow to maintain that house? Can you
Yeah.
pay the property taxes and the insurance? And so you do have to think about the future implications of what's going to happen once the divorce is final.
Yeah, and I'd say from the valuation side is one is really understanding what the assets are actually worth. One of the biggest challenges is simply understanding what the marital assets are worth. That could be a business, investment accounts, retirement plans, or real estate. Two assets may look similar on paper, but have very different economic value.
Yeah, that's a good point.
Another issue is liquidity, and Brandi, touched on this just now. A business owner, they might have significant value tied up in that company. They may not have the cash available to simply just write a check as part of a divorce settlement. And so really, understanding that whole financial picture, sometimes both spouses have a clear understanding of the finances, but sometimes one spouse has managed a business or the household finances for years, and maybe the other spouse hasn't. So in situations like that, part of our job is simply helping everyone understand what the financial picture actually looks like.
Yeah. Brandi, what are the biggest tax mistakes that people make during a divorce?
Well, I would start by saying it's waiting until the divorce is finalized before you start thinking about the taxes, because that really should come into the conversation much, much earlier.
Yeah.
But beyond that, it's making sure you understand the true value of the assets, not necessarily the current value as what they are today, but what the value is after taxes, because that may not be considered until much later. And then also understanding how your filing status with your tax return works. Once you have filed for divorce, up until the point that you've actually, the agreement is signed and everything is final, there are misconceptions around what your filing status is, once you've started going through this process. We've seen, multiple times where the assumption is you're single or you're unmarried once you've started going down that path, but that's really not the case. You have to wait until everything's finalized, and then you have additional options to file separate from your spouse. And so there are certainly options leading up to that, but talking with a professional and really understanding what you can do in that situation just to avoid having to file amendments later.
Yeah. Well, one of the things I see all the time that I know enough to know to explain this to clients is like, they don't understand that you have to be married on December 31st of that tax year to file jointly. So
Absolutely,
like if they're
yeah.
getting divorced now, we're recording this in July. Sometimes they'll want to say, well, we're going to file a joint tax return for 2026. And I have to say, you cannot do that. Even lawyers don't. A lot of lawyers don't know that.
That's right. Yeah. Everything is based on December 31st. If you're married that day, then you're going to get to file jointly. But if you become divorced any day prior to that, you are then going to be either single or head of household.
Yeah. Brandi, are there assets that may seem equal in value but have very different tax consequences?
Absolutely. And this is what we were alluding to earlier. So you can't focus on just the current value of that asset. You really do have to consider the after tax value when you're allocating assets. You think about things such as investment accounts that have unrealized capital gains. There's going to be a tax due when, once those stocks are sold. Real estate appreciates in value. You have retirement accounts that are funded with pre-tax dollars. All of these assets will have a future tax obligation. And so you really have to think through all of those pieces when you're, coming up with your asset list. If you think of the example of if there's 100,000 sitting in a bank account, and then you have 100,000 sitting in a retirement account, on the face of it, those seem to be the same, but they're not. That cash that's currently available, there's no additional tax that's going to come from pulling cash out of a bank account. But if you pull that money out of retirement, you're going to receive much less than that. And so it's not the same money going in your pocket at the end of the day. So you've got to think about those things on the front end.
Well, and if you're younger than 59 and a half, you're going to have a penalty for the retirement account too, on top of that. Yeah,
exactly.
What tax issues should people discuss with a CPA before signing a divorce agreement?
Yeah, so I think the asset allocation is probably the biggest one. Just making sure you're going through that exercise with a professional that can understand the type of tax that will apply to a potential asset sale in the future. But beyond that, I would say, have a discussion around any dependents that may be involved. A lot of times that is addressed in the divorce agreement, who's going to claim the kids and who's going to have custody. But there are a lot of different tax benefits that come from having dependents. And you need to have a conversation to understand what's allowable under the Internal Revenue Code, because there are some misconceptions that the divorce agreement says I'm going to claim the child, but that doesn't necessarily mean they're entitled to certain tax benefits if they're not the custodial parent. So having that conversation on the front end can at least avoid any confusion later, and some misconceptions perhaps around that. And then the last thing I would say is have a discussion about the primary residence. There may be, the plan to sell the home prior to divorce or even right after, or one of the spouses obviously would retain it and continue to live there. But there are gain exclusions available through the Internal Revenue Code when you sell your primary residence. And as a married couple, that's a $500,000 exclusion versus a single individual that drops to $250,000. And so I think proper planning around that on the front end, again, everybody's situation is unique. And so you do have to consider all the factors, but that can be an important planning discussion on the front end just to make sure that gain exclusion can be maximized if that house will be sold in the near future.
Yeah, for sure. What's one piece of tax advice you wish everyone knew before they get divorced?
I would say simply just understand the financial consequences before you make the decision, because otherwise you're going to get down the road and realize that there were some unintended consequences of some things that you were quick to, just rush through and just negotiate the deal and let's move past this. And so once that happens, there's really not a whole lot you can do at that point. And so you really do need to think through that on the front end.
Right. Because, it's important to note that anything to do with assets and debts is final when a divorce is final. So, if you agree to a certain disposition of an asset and then after the fact you realize that it has an adverse tax consequence, you can't go back and modify that part of the divorce. It's not modifiable.
Exactly.
So you're stuck.
Mm-hmm. That's exactly right.
Well, Lyndsey, when is a business valuation necessary during a divorce?
There are many situations. Mainly, I would tell you it's when one spouse owns a business or part of a business, and that might be a business like a professional practice or a family business. Often we see this in closely held companies. Now, even if neither spouse plans to sell the business, they still need to know its value because that might be divided through other assets. So I would think of it like valuing a family home. Nobody has to sell the house immediately, but you still need to know what it's worth.
Yeah. What does a business valuation actually involve?
So first thing we do is we just gather the financial records and we learn how that business operates and we understand the industry. So many people think business valuation is, just plugging numbers into a spreadsheet. But in reality, much of our work revolves around understanding the story behind the numbers. So once we evaluate all the risk and we understand what the future earnings of a business looks like, then we apply recognized valuation methodologies. And just to give you an example of that, let's say you've got two companies that each of them generate $5 million in revenue. One of those companies may rely entirely on its owner, meaning that owner does all the work and that owner is responsible for generating that $5 million. Same company owns a different company generates $5 million in revenue. That company might have a management team, recurring contracts, and diversified customers. Those two businesses, while they have the same amount in revenue, they can be totally different values because that story underneath the business is different.
Yeah. Because, like in the example of where the business is the owner, that business really isn't worth anything when the owner's not there.
Right. Absolutely. And there's no structure in place that if they were to, say sell that company, that somebody could just walk in and assume those responsibilities.
Mm-hmm. But if it's like, Mr. Bob's mechanic shop and all the customers just go there because they know and like Mr. Bob, that's not worth anything if Mr. Bob's not around.
That's right.
Yeah.
But if Mr. Bob has trained all of his mechanics and Mr. Bob sits in the office and oversees all the mechanics and they do all the work, that's a different story.
Yeah. Yeah, that makes sense. I mean, you think that's how big businesses operate,
Exactly.
Yeah. When does forensic accounting become necessary and what kind of financial issues can it uncover?
So first of all, let's talk about what forensic accounting is, because people like to throw this term around.
Yeah.
So valuation helps determine what a business is worth, but forensic accounting can tell us, is the financial information complete and accurate? So think of evaluation as taking a snapshot of what the business is worth, but forensic accounting is more like investigating how that picture was created. What happened underneath there? We say a lot, this is kind of like follow the money. Money leaves a paper trail and numbers don't lie. So when there are concerns for things like hidden income, maybe personal expenses being run through a business, unreported cash, missing assets, there might be transfers to family members, and there might be some unusual changes you've noticed in the financial picture prior to a divorce. These can all lead to a desire for forensic accounting. And I want to also say, we don't begin assuming fraud. We just simply follow the financial records. And that's an important distinction to make, because just because somebody might have mismanaged assets doesn't necessarily mean what they did was somehow illegal, because people hear the term forensic and they're like, oh, well, somebody must have committed fraud. That's just not necessarily the case.
Yeah. Plenty of people just don't know what they're doing. Right. But yeah, I mean, I immediately think about those situations. I mean, I've had lots of cases over the years where somebody, has a fancy house and vacation homes and lives this high lifestyle. And then when they produce their tax returns in discovery, it all says they make negative income every year. So to me, that's a situation where I'd be going, I might want a forensic accountant to look at this, because obviously that's not, how do you do that?
Right. Absolutely.
Legitimately. Yeah.
Absolutely.
What's one misconception people have about business ownership and divorce?
Okay, well, there are a couple. I know you just asked for one, but I'm going to give you a couple.
So
the one is, I built it. A business isn't worth whatever the owner sacrificed to build it. Markets, they don't pay for effort. They pay for economic benefits. So a lot of times people have that, personal tie to that business, all that sweat equity that they put into it. It doesn't necessarily mean that the business is worth something.
And I think that's true for assets generally in a divorce. A lot of people think oh, somebody's going to do an accounting and make sure I get paid back for every cent I put into this marriage. And it just doesn't work that way.
Absolutely. Another common misconception is people think, well, the business value equals what's in the bank account. Many owners think, oh, I've got $300,000 in cash. No, the business value comes from the future earning power. We look at business valuation as a point in time, as what we look at the past is what could that business earn into the future.
Mm-hmm.
And then lastly, I'd say revenue isn't value. A company doing 10 million in sales isn't automatically worth more than one doing 2 million. Profitability matters, risk matters, growth matters. All of these things, you just can't look at it in a vacuum.
Mm-hmm. And you take all those into consideration when you're doing evaluation, right?
Absolutely, yes.
Well, and a CVA, unrelated to businesses, but a CVA can also help you if you have a retirement issue, right? Not a lot of people have pensions anymore, but say you have a situation where someone has a pension and part of it was earned before the marriage, part of it was earned during the marriage. Can a CVA help you figure out what is the marital value of that asset?
Yes, I think so. I mean, that's really also just sort of a simple accounting matter. We figure out okay, what did you start with when you came into the marriage, right? And where have we ended up at the end? And how much of that was your original principal that you put in, that you earned during that marriage, versus what did that asset earn during that time?
How do attorneys, CPAs, and valuation experts all work together to help clients achieve fair outcomes?
I would say, I think our goal here is better information. Better information leads to better decisions. Attorneys are looking out for the legal rights. They're protecting those legal rights. CPAs, we're understanding the tax consequences. And then the valuation expert helps determine that financial value. And the goal for all three of those things is just to have the most information available. So better information leads to better decisions.
And I would venture to say a better outcome, because you've got the right team together that's coming to represent, the client, the person that's going through the divorce, to ensure the best outcome for them.
Mm-hmm. Well, and from my perspective, I think about when you're trying a case, it's so important to present good information because you don't want what you're presenting to fall apart under scrutiny in court. So if you have a qualified team like you guys who's doing things the right way, I can be confident that whatever I present that comes from Brandi Morgan or Lyndsey Dixon is going to hold up to scrutiny. And then also just the perspective of you go in front of a domestic relations judge to get divorced, you think they've got 1,000 cases a year. And if you just throw them a mess of financial documents and expect them to figure it out, you might not get as good of a result. They're going to try their best, but they're not accountants or CVAs either. So it's your job as the attorney to put together a clear, easy to understand presentation for the court, especially about complicated financial issues.
Alison, you hit the nail on the head. That is exactly what we try to do. We try to take these complex financial matters and make them simple for people to understand, whether that be a judge, whether that be a client, the attorneys. We try to make this here is this complicated mess of stuff, but here is an easy way for you to understand it.
Yeah. And a lot of people are afraid of numbers. Attorneys joke all the time that the reason that they're attorneys is because they're bad at math. That's one of the oldest lawyer jokes in the book. And it's, it's a cliche for a reason.
I'll tell you this, kind of off topic, but I came home from college and I told my parents I was going to major in accounting. And my stepdad, who owns a business, he said, "Great, what's 1 + 1?" And I said, "I don't know, 2." And he says, "Wrong. A good accountant would tell you, what do you want it to be?" But that I guess that drives home the point that what we do is so much more than just math, right? Anybody can use their iPhone or Microsoft Excel to add numbers together, but it's really, what do those numbers mean, and telling that story behind that, whether that's determining the tax consequences, or maybe, a lot of what Brandi and I do is work in that financial world and explaining people this is what your financial statements look like, but where do you want to go and how are we going to get there? And then in the valuation world, how did you create value based, just telling that story and bringing that all together? Because I think that's the part that scares people. It's not the math. It's what does it mean?
What do you do with it?
And it's about how can you make strategic decisions to hopefully get a better outcome. That's what everybody wants.
Absolutely. And you've got to start with good numbers to even have that discussion.
For somebody who's just beginning the divorce process, what do y'all think are some of the first important financial steps that they should take?
Well, I think step number 1 is get organized. You've got to start putting together all the pieces of what is your financial picture. So, gathering your bank statements, tax returns, mortgage information. If there is a business involved, you need to get the financial statements. And so pulling all that information together, but even going beyond that and actually sitting down to make sure you understand what is it that you own, what do you owe, how much income is coming in, what expenses are going out. So the more prepared you can be with that information, the more productive that meeting can be when they come to meet with you, Alison, or if they're meeting with a CPA. Understanding how all the things fit together before even having that first discussion can be really helpful and set the tone for the path forward.
Well, where can listeners learn more about Wilkins Miller and the services that y'all provide?
Well, you can start with our website, wilkinsmiller.com. You can learn about our firm, our team, and all the services we provide. We're on social media, so you can follow us there, Facebook, Instagram, and so forth. And then we also have a YouTube channel. We do an On the Money series where we put out content on just a variety of topics just to help individuals and businesses make better informed decisions. So go check us out.
That's great. Well, Brandi and Lyndsey, thank you so much for sharing your expertise today. Understanding the financial side of a divorce can really help people avoid costly mistakes and make more confident decisions so they can move forward and, plan that next step. Think about the future. If today's conversation was helpful, be sure to subscribe to the Herlihy Family Law podcast so you don't miss future episodes covering important legal and financial topics that affect families. And check out Wilkins Miller's On the Money on YouTube. If you'd like to learn more about Herlihy Family Law, you can visit www.herlihyfamilylaw.com. To learn more about Brandi Morgan, Lyndsey Dixon, and the team at Wilkins Miller, you can go to wilkinsmiller.com. Thanks for listening, and we'll see you next time.
Thank you for tuning in to the Herlihy Family Law Podcast. Remember, you don't have to face family law challenges alone. Visit herlihyfamilylaw.com or call 251-432-7909 to learn more.